the hidden $3 trillion debt crisis nobody's talking about. The headlines might be full of AI, elections, and oil prices, but behind the scenes, something far more dangerous is happening. Wall Street is quietly dealing with what some are now calling the next big financial shock: the collapse of confidence in America's private credit market. In early October 2025, a major US car parts maker called First Brands Group filed for bankruptcy. On paper, it's just another corporate failure. But the real story, the one that sent shockwaves through Wall Street, is what that collapse revealed about the shadow banking system. Because when First Brands went under, it didn't just take itself down, it exposed cracks in a $3 trillion market that most people don't even know exists. A market built on loans made outside the traditional banking system. Here's what's happened. First Brands Group, a company with $5 billion in sales and 26,000 employees, suddenly filed for bankruptcy in late September. Within days, the fallout began. One of the banks caught in the crossfire was Jefferies, a $10 billion investment firm based in New York. Through a fund it partly owns, Point Bonita Capital, Jefferies had hundreds of millions in exposure to First Brands. As the news spread, panic set in. Big-name investors like Morgan Stanley and BlackRock reportedly tried to pull their money out of Point Bonita almost immediately. Jefferies shares plunged more than 20% in just a few days. The Telegraph reported, bosses at a US banking giant are scrambling to restore confidence in their business after getting caught up in a $12 billion bankruptcy case that has sent tremors through Wall Street and beyond. And this wasn't just about Jefferies. The entire financial system began asking the same question. If this is what's happening at one of Wall Street's most respected banks, what else is lurking in the shadows? Private credit, sometimes called shadow banking, is part of the financial system that operates outside traditional banks. Instead of companies borrowing from commercial banks like JP Morgan or HSBC, they borrow from private funds, often run by investment firms and private equity groups. It's become massive. The private credit market is now worth around $3 trillion, up 50% in just a few years. Pension funds, hedge funds, and asset managers have all piled in, lured by promises of turbocharged returns. But there's a catch. This market isn't heavily regulated. There's no central oversight, no Federal Reserve, stress tests, and very little transparency about what's really happening under the hood. The market is lightly regulated and not very transparent. It has expanded 50% as the prospect of turbocharged returns has drawn in pension funds and other more traditionally conservative lenders and investors. The Jefferies-backed fund, Point Bonita Capital, had around $715 million in exposure to First Brands. That's nearly a quarter of the company's entire portfolio. When First Brands fell, Point Bonita was suddenly staring down enormous losses, and its investors wanted out. Jefferies tried to calm everyone down. In an open letter, the bank's executive said, "We believe there has been an impact on our equity market value and credit perception that is meaningfully overdone. And we expect this to correct as soon as the facts and range of outcomes are better understood." But markets don't wait for facts. Fear spreads faster than any official statement. The bank's shares tanked. UBS, another global financial powerhouse, was also caught up in the First Brands fallout, adding to the sense that this could be the start of something bigger. The problem isn't just one company or one bank. It's the entire structure of how private credit works. These loans often depend on risky forms of collateral, like trade finance, where invoices for future payments are used to secure loans. If even a small percentage of these borrowers default, it can trigger a chain reaction across hundreds of funds and thousands of investors. That's exactly what regulators are now worried about. Other US bank stocks have also dropped amid fears that there could be further financial landmines lurking in the opaque $3 trillion world of private corporate debt. The fear is simple. Nobody knows how deep the problem goes. The Bank of England has been warning about this for months. Private credit's rapid growth and lack of regulation make it fertile ground for hidden risks. In fact, ratings agency Fitch recently described the sector as having bubble-like attributes, including rapid growth and financial innovation, spread compression, heightened competition, growing retail participation, and rising borrower leverage. That's eerily similar to the language economists used before the 2008 financial crisis, when years of easy credit and hidden leverage suddenly came crashing down. And history shows that when financial innovation outpaces oversight, it rarely ends well. Is this another 2008? Not yet, but the warning signs are there. The good news is that private credit still makes up a relatively small part of the total financial system. Private credit was still a relatively small portion of the overall financial system. The bad news? It's growing fast, and no one really knows who's on the hook when things go wrong. Because many of these funds lend to the same types of companies, one major default can ripple through dozens of portfolios, just like subprime mortgages did in 2008. What made 2008 so devastating wasn't just the number of bad loans, it was the web of financial products that spread those losses everywhere. Subprime mortgages were sliced, repackaged, and sold around the world as safe investments. When they started to fail, the contagion didn't stay in housing, it tore through credit markets, hedge funds, and global banks. Private credit has echoes of that same structure. The loans may be different, but the opacity and leverage are eerily familiar. Many of these funds lend to the same borrowers, finance similar industries, and depend on investor confidence to survive. If redemptions accelerate, they'll have to sell assets into falling markets, creating the same vicious cycle that once brought down Lehman Brothers. Even Jefferies itself admitted that it could take years to recover the money, saying, "We take this matter extremely seriously and will do everything in our power to recover the money and the assets that are rightfully owned by our co-investors in Point Bonita." Translation: they're worried too. And there's another twist. Jefferies claims the First Brands collapse wasn't just bad luck, it might have involved fraudulent activity. The company's chief restructuring officer and the US Department of Justice are both investigating. The founder, Patrick James, has already resigned, but he insists he did nothing wrong. A spokesperson told he always prioritized the company's interest above his own, and he remains deeply committed to the success of the business and the maximization of value for the benefit of its customers, suppliers, employees, and lenders. Even if that's true, the damage is already done. So, what does this mean for everyone else? Private credit was supposed to be the safe alternative, a way to earn higher returns without the volatility of stocks or crypto. But now it's looking like a black box filled with risks nobody fully understands. The fallout from First Brands has revealed how deeply intertwined the traditional and non-traditional financial systems have become. Banks like Jefferies and UBS aren't just lenders, they're investors in private funds that behave like hedge funds. When those funds start to wobble, confidence in the whole system shakes, and that's exactly what is happening right now. Wall Street's problem is that this time the danger isn't sitting on balance sheets that regulators can see. It's hidden in private markets. and those are much harder to control. If more companies like First Brands collapse, it could trigger a chain reaction of redemptions and force sales across private credit funds. That would tighten financial conditions even further, hitting small and medium-sized businesses that rely on these loans. The bigger risk isn't a sudden crash, it's a slow bleed. One fund after another freezing withdrawals, one company after another missing payments, and confidence quietly eroding. And once confidence is gone, it's incredibly hard to get it back. That's why Jefferies is now fighting to contain the fallout, promising investors that losses are manageable. But the truth is, nobody really knows how deep the cracks go. So when you hear analysts say the financial system is strong, remember this: there's an entire parallel banking universe worth trillions of dollars operating mostly in the dark. And as this latest crisis shows, it doesn't take much light to expose what's really hiding there. If you found this breakdown helpful, hit that like button, share it with someone who follows the markets, and don't forget to subscribe to Eureka.